Once again, good evening, everyone. This is John Guiliana, and I welcome you to tonight's webinar, Optimizing Your Practice with Time-Tested Management Strategies. Tonight's webinar is hosted by TRAKnet Consulting Solutions. I'll be sure to tell you a bit about that a little bit later during this webinar, but first, as we usually do, some housekeeping. As with all of our webinars, everyone here is in a listen-only mode. We're going to be happy to answer any questions that you may have at the end of this webinar. Anytime throughout tonight's webinar, simply type in your questions into the question box located on the right-hand side of the webinar screen. Now, we have a couple of hundred people registered for tonight's webinar, so I'll do my very best to try to consolidate the questions, look for commonalities in the question, and try to answer as many as I can. But at the very end of the webinar, I'm going to do something rather unique that I haven't done in other webinars. I'm going to not only provide you with an email to inquire about services of TRAKnet Consulting Solutions, but I'm also going to provide you with my personal email. And if you have any residual questions that were not answered, I invite you to please go ahead and email me. As long as it's pertinent to tonight's webinar, I will be happy to answer those for you. Tonight we're going to discuss management strategies and how you truly need to keep your fingers on the pulse of your practice. Well, I'm going to be showing you how to acquire some of the data that we'll be talking about using the TRAKnet reporting system. This really isn't going to be about TRAKnet. I want to focus on the strategies designed to help us all improve our practices. While the reporting platform, the basic reporting platform in TRAKnet, will be there as we roll out our new version, there's also going to be a whole host of advanced optional reports that you can subscribe to. But what I'm going to focus on tonight is the metrics that you should all be measuring clearly available in the basic reporting platform of TRAKnet. So again, this won't be a webinar necessarily designed to train you on the reporting platform. We could always do that in the future, but we're going to talk about what metrics can you be measuring using even the basic reporting platform of TRAKnet, not necessarily the advanced practice management reporting platform. This is a phrase that I hear all the time from physicians all across the country, whether they're podiatrists or allopathic or osteopathic physicians. I've done lots of consulting in the field of medicine. Everybody feels as though they are working harder and harder and making less and less. And there's a reason for that, unfortunately. As we continue to focus harder and harder on the quality of our patient care, now mixed in with the daunting meaningful use and PQRS criteria and many other regulatory issues distracting us, we're forgetting that we also run a business and we need to keep our fingers on the pulse of that business. And that is really what we're going to talk about tonight. I'm going to start with some of the financial reports that are really necessary for you to understand and query regularly and look for variances in normals or look for patterns of variances. The very first report we'll talk about is the aging report. Now, everybody knows what an aging report is, but just to make sure we're all talking about the same thing, an aging report will show you the monies owed to your practice, whether they are from patients or from insurance carriers or a combination of both. And an aging report is simply broken up into buckets that are 30 days old since the date of service, 60 days old, 90 days old, and so forth. Now, one of the problems associated with an aging report is frequently the fact that the aging report is adulterated. It's adulterated with monies that really are not collectible. They're monies that should have been written off basically maybe because of your contractual arrangement with the carrier, or you simply know you're not going to get this money for one reason or another. So our aging reports are often very skewed. In TRAKnet, we have an account receivable report. I am in the reporting section here within TRAKnet, and you can see that I am querying the account receivable report. I could run a summary, as you see here, or I can run it as a detail which shows the actual encounters. Also, I can use the filter at the bottom to determine whether or not I want the aging report to show me just patient responsible monies or both patient responsible and insurance money. I could even filter the days past due. If I didn't want to show, for example, 30 through 90 and I only wanted to show those claims that are aged greater than 90, I could do that as well. Now, one of the problems associated with the account receivable report, one of the challenges, and we're working on some strategies to actually correct this, is that you must remember, if you are going to be submitting, or I should say resubmitting a claim, suppose, for example, the carrier wants the medical records and the claim needs to be resubmitted with the medical records, you're dropping it to paper. You must go back and clear the history of that initial encounter, or you're going to be duplicating that AR, and it's going to skew your report. Furthermore, in this particular AR report, encounters that have been created but not yet sent to the insurance carrier also show up on this AR report. So, for example, if I saw a patient and entered charges, but my billing department doesn't want to send it yet because I'm behind in my documentation, that encounter, the monies associated with the charges, shows up now on my AR, even though that claim has not yet even been sent to the insurance carrier. So many people have turned to the other type of account receivable report in TRAKnet, and it's known as a pending claims report. And you can see I'm querying here the pending claims report. I'm running a summary. Again, I can run a detail if I want. I can basically tell it through the filters on the bottom that I want to look only at primary insurance, or I can choose secondary or even tertiary insurance. And like the general AR report, I can filter out the days past submission. I could do it by locations. I can do it by providers. You see that it's going to give me a list of the insurance carriers. Here I queried only 90-day plus. It's going to show me by insurance carrier the claims that have actually been sent to the carrier. And it mitigates the other problems often associated with the account receivable reports in terms of duplication of history. Now I could always look at this report and say, Medicare seems to be way out there, off the charts, owing me money. I can then go run a detail report to see exactly what accounts are being affected by Medicare. Another financial report that everybody should be running, whether you do it in QuickBooks on your own or you have your accountant provided to you, is your profit and loss statement. A couple of points I want to make about the profit and loss statement is the fact that typically your profit and loss statement starts with basically a financial snapshot of your practice for a period of time, for example, a quarter or a year, and it shows you on your top line your revenue produced. Then it lists the expenses that you've incurred to generate that revenue. And a point I want to make about your profit and loss statement is the fact that these expenses should be broken down abundantly. For example, I don't like to see an expense category of insurance. I'd rather see that be insurance and then broken down into workers' comp, health insurance, malpractice, general liability, all of the insurances listed. Make your profit and loss statement expenses as detailed as possible, because as you're going to see, I am a person of looking at trends. And the only way you can really look at ominous trends occurring in your practice is to have that expense detailed as much as possible. Speaking of trends, let's take a look at some of the reports you should be looking at and running to monitor your practice trends. Now, when we talk about practice trends, it's important to understand that while the raw numbers that we're going to speak about are sometimes important, in many instances, even more important is the quarter-over-quarter variance. And it's important to measure the same time frame year over year or quarter over quarter. So for example, you're comparing the first quarter of this year to the first quarter of last year, or the third quarter of this year to the third quarter of last year. It gets rid of the variances associated with things like seasonal changes in your practice. What are those trends that you should be monitoring? First, total patients. Your total patients are basically acquired through the report. As counterintuitive as it is, your reports are acquired through something known as your average collection report. And I can't explain why the average collection report is the only place that you could acquire this data, but notice in the first column of your average collection report, every time you've started an encounter, it's accrued here. So this gives you a total patient visit, and you can break it down in the filters below according to location and query any time frame that you want. So total patient visits are important to monitor, and you'll see how we build upon this type of data as we begin superimposing data. Your new patients are very important to monitor. Where you acquire that data from is treatment by providers. And again, I'm running only a summary report. I could query any date, but important here is that you enter the treatment codes that you use for new patients, 99202, 203. If there are other types of new encounters that you use, you simply list them here. And it gives you a breakdown by provider of your new patients. Now, talking of superimposition of data, it's important to really superimpose your total patients on your new patients. Your new patients should always occupy greater than 10% of your total patient visits. And the reason is that in every typical practice, there's a certain attrition rate, and it's important that you meet or exceed that attrition rate by having an influx of new patients. So use the benchmark of 10% of your total patients should be occupied by new patients. If it's not, it might be time to consider a marketing strategy or a marketing plan. Another report based on trends is the CPT report that you should run quarterly. Again, comparing the quarter of this the period for this quarter compared to the same quarter of last year. Where you get your CPT report from is essentially the same report that I just ran for new patients. It's treatment by providers. But now what you're going to do is simply leave this area blank where it says treatment codes, and it will literally run every CPT code that you had for this time frame in the filter. Now suppose you run this and you notice that for this quarter of this year, you are significantly down in, let's say, matrixectomies. Your utilization of 11750 is significantly down this quarter of this year compared to the same quarter of last year. While that might be an ominous sign, it might not be, and you won't know whether it is or not until you superimpose it on the next report, which is your ICD9 report. Your ICD9 report is going to show you whether or not a low utilization comparatively is meaningful. So here you see me querying patients by diagnosis and very simply same time frame I type in ingrown toenail, which I always associate with a matrixectomy. And now if I see a significantly lower amount of ingrown toenail patients in this list, it's going to tell me that my lower utilization of 11750 is not indeed ominous. It should be expected. Production reports. The simplest production report to run is known as an activity report. Another report that, as we roll out 3.0 in 2015, we're going to be adding to this activity report. As you notice here, the activity report can be run by the date, and it gives you the charges by provider. It gives you the payments for that date, for whatever date range you've queried, but it breaks down the payments into check, credit card, and insurance, but it doesn't break down the payments to providers, unfortunately, and that's going to be added to this particular report so that you will see, rather than having to go to your filter and running each provider separately, which you can always do, it's going to list it here on the main screen of this report. But this is the way that you look at productivity for a period of time, what you charged and what you collected for the time frame that you're querying. The per-visit value, many of you who have heard me speak at various conferences know that I like to associate a per-visit value also with the productivity of a physician and the compliance of that physician in clinical protocols. And we'll talk a little bit more in detail about this later on, but right now I just want to define what a per-visit value is and how you superimpose two different reports to achieve this value. A per-visit value is basically what each individual patient who sits in your treatment chair contributes to your total collections. And you arrive at this value by looking at your collections, and again, you're querying that on your activity report, and you divide into that your total patients. And again, you query that using your average collection report, that first column in your average collection report. One of the things about per-visit value is that if you run it too frequently, you invalidate the report because there's such huge variations on a week-to-week, month-to-month basis of what your per-visit value is. A per-visit value really should only be run at the most twice a year using these two statistics, collections over total patients. Now, total patients means only those patients who are sitting in your treatment chair, whether they're new patients, subsequent patients, even those patients who are no-charge visits because they're within the global period of postoperative care. Anytime you make an encounter, it basically totals into a total patient visit. It doesn't include the collections that you might have acquired through a wound care facility or a surgery center. It's strictly office. So if in the office you collected $1 million this year and you did so on 10,000 total patient visits, your per visit value is $100. A lot of people ask me, what is the benchmark for per visit value? It's very difficult to assign a benchmark to this. There are such variances across the nation according to the type of practice that you have, according to your payer mix. More important is to just know what your per visit value is and benchmark it against yourself year after year. And if you know nothing has changed, there's been no parameters that have changed within your practice, such as you didn't lose a very lucrative insurance carrier, and your per visit value is declining, you need to investigate why. And we'll talk about some of those reasons shortly. But a per visit value to really use as a national benchmark, I will tell you that podiatry hovers anywhere between 75 to 90. but there are plenty of practices out there that have $130 per visit values, $140 per visit values, and unfortunately, there are plenty of practices out there who are at $40 per visit values. And we'll talk a little bit about the root cause of those in just a second. Let's now talk about taking that data that we just acquired, the fundamental metrics of your practice, and assigning some benchmarks to them for those that we know we have industry benchmarks with. So first, let's talk about those that are related to the single most important thing in your practice, and that's your cash flow. And I know that most of us would define the single most important thing in our practice to be the care of our patients, but I will debate with you that while that is absolutely crucial, if you do not have cash flow, you can't possibly provide quality care to your patients. And in fact, if your cash flow becomes eroded to the point where you can't make your payroll, you are by law out of business. So one goes with the other. Your cash flow related benchmarks are really associated with your account receivable management. Your total accounts receivables, whether you use your total account receivable reports or a combination of that in your pending claims report, your total accounts receivables, monies owed to you by patients and carriers, should be less than 2 months of what you bill out. So for example, if you charge out $50,000 per month, this is not collected, this is what you charge. If you charge out $50,000 per month, you should be critical of your AR management if your total accounts receivable climb to greater than $100,000, twice what you charge out in a month. That's the first benchmark. A more important benchmark is the fact that your aged accounts, and by that I mean your accounts that are over 90 days old, should occupy less than 15% of your total accounts receivables. If you have 40% of your total accounts receivables in that 90-day greater bucket, you've got to ask questions. Now, remember what I said before. That question might be, is this AR report valid? Or do we know for a fact that a lot of these claims sitting out there for 6 months, for 1 year, are on the AR report, but they are truly not collectible? This 15% benchmark is really related to truly collectible money. And that's why it's very rare, unless somebody is very diligent, an administrator is very diligent of getting rid of what is deemed uncollectible. It's very rare that I see an AR report that is completely unadulterated. How long is it taking your average claim to be paid? Now, I realize that claims of some insurance carriers are paid literally within 10 days. Other carriers, it's like pulling teeth. They take way longer. But it's good to keep your fingers on the pulse of, over a period of time, again, do not try to calculate this for anything sooner than every 6 months because it varies too much. How are your claims being paid in terms of days in receivables? That's how you define the average time it's taking your claims to be paid. Very simple calculation. You look at your total accounts receivable, you divide into that your gross charges for the year, then you multiply that number by 360. That's going to give you how long your average claim is taking to be paid. I would expect, and again I say this cautiously because some of you might be in an environment with a payer mix where it is really very difficult and enormous resources are spent trying to get paid. The average podiatry practice probably has days in receivable of about 45. It's taking 45 days to get your average claim paid. Everything we just talked about, again, these metrics associated with cash flow boil down to account receivable management. So let's break it down to root causes. If I see accounts receivables that are way too high, off the chart, there are 4 fundamental areas I'm going to look at. What are your collection policies? And I'll talk about that in just a second. What are your collection policies? Number 2, I often find, once again, there's a failure to write off what is supposed to be contractually written off. So the account receivable report truly isn't out of order. This third fundamental reason is often that you are sending out claims without proper modifiers, without following correct coding initiatives. In other words, your clean claim rate is too low. You are getting way too many rejections. Those rejections then have to be reworked, and that takes time. And meantime, the clock is ticking, and your account receivables, those buckets, are shifting to the right on you. So make sure that you're following correct coding initiatives. Make sure that somebody's doing an initial scrubbing of the claim, checking for modifiers. Make sure that you get to seminars, understand all of these things to get your clean claim rate as high as possible. And then the fourth factor are those things that are simply outside of our control. Unfortunately, insurance carriers make their biggest profit not by taking in premiums from their beneficiaries and then providing the providers of the care with monies. That's not how they make their profits. They make their profits by taking money from their beneficiaries and holding that money as long as possible and investing that money. And the longer they have that money, the greater their return on investment. So these are factors simply outside of our control. We need to focus on those things that are inside of our control. This is a common question that I'm often asked, and I'd like to address it. John, what should I collect versus what I bill out? I'm often asked that question, and my answer is that depends. It really depends upon your billing habits. So if you talk about that question, what should I collect based on what I bill out, you're speaking about a gross collection ratio. And I think everybody here would agree that if you bill $30,000 for a simple bunionectomy, your collection ratio is going to be awfully low because the collections are linked to something that's outside of our control for the most part, and that is the fee that you've contractually obligated to accept by that carrier. Instead, what I like to speak about, and it mitigates this problem of all of us having different fee schedules, is a net collection ratio. And if you talk about a net collection ratio, you are speaking about what you collect versus what you bill out after you subtract out your contractually obligated write-off. Now you're dismissing what you need to write off contractually, and you're comparing only then your collection versus what you charge. That's a net collection ratio, and that should be almost 95%, inclusive, of course, of secondary carriers, inclusive, of course, of what the patient's obligations are. It should be 95%. Many people will ask, by the way, well, why shouldn't that be 100%? Well, if you could get it to 100% without outright fracturing your goodwill and the patient relationships, you're better than me. Shoot for 95%. There's always going to be that 5% for reasons that are very valid. Patients can't pay you, or that you simply have to write off for better goodwill, if you will. Everything, when we talk about account receivable management, rests upon having a strong billing and collection policy. I don't mean for you to really read and absorb this slide, but this is an example of a billing and collection policy where your billing department has to understand and have policies about what to do with claims when they reach 30 days old. What do you do when they're 60 days old, 90 days old, and lastly 120 days old? Firm action steps have to be documented and educated to the people doing your billing. Okay, let's move away now from financial and trends, and even move away from account receivable and cash flow related benchmarks. Let's talk a little bit about performance benchmarks. I'm very often asked about, well, how do I know whether I'm staffed appropriately, if I have enough help in my practice? And ironically, many of us walk around thinking that we are truly overstaffed. And I will tell you from experience that while that might be the case, I will tell you from experience that the vast majority of the practices that I look at analytically are often understaffed. So here's the exercise that you basically go through, and here's where you query it in TRAKnet. It's called the payroll ratio. It's going to look at your collections. Again, you're obtaining that from your activity report, and you're going to look at your payroll. And of course, you're going to get your payroll from your profit and loss statement. Now, first, let me define what I mean by payroll. Payroll does not include the producers of the practice. It doesn't include the physician's salary, only your staff's salary. If you outsource your billing for a certain percent, in the end, you have to add that percent as well, because they're truly an extension of your staff. It also includes not just the salary of these staff members, but it includes the payroll taxes and any benefits that you provide them, such as a 401k. That all-inclusive is what you define as your payroll. You simply divide that number into your total collections, multiply by 100, and it's going to give you a payroll ratio. So for example, again, if I had $1 million of collections and my payroll, everything that I just defined, came to $260,000 for the year, my payroll ratio was 26%. That's your payroll ratio. Where does the average podiatry practice fall in its best environment? Somewhere between, and I know this is a broad range, but the range can vary depending upon the type of practice you have, the training that your staff has, and how much you empower that staff to do. But somewhere between 25 and a 30% payroll ratio would be basically hitting the mark. 25 to 30%. If I see a payroll ratio, that's 50%. There better be a darn good explanation for it. Often the explanation is ominous. It's not a good explanation. Often the explanation would be that you don't have clear, concise job descriptions. You don't have a good recruiting and training process. So you're hiring all these people and your wheels are spinning and people are bumping into each other. Nobody's doing clear, concise job tasks. Your payroll ratio is going to creep up tremendously, and it's going to eat away at your profits significantly. Your payroll is often the single biggest expense of your practice, maybe second, to things like your mortgage if you own the building, but your payroll is a significant amount. So keep your fingers on the pulse of the payroll ratio. Now, if I saw a payroll ratio of 10%, I get just as worried about that too. There better be a good reason for that, because it is very possible to not only be overstaffed and have a high payroll ratio, but it's also very possible to be operating way too lean and being understaffed. And when I see a payroll ratio that's frighteningly low, I go back and I look at this number again, this PerVisit Value number. And I often look at practices over years, and I can paint a picture as I'm seeing their payroll ratio decrease because they're eliminating jobs, they're downsizing. I'm seeing a concurrent erosion of their per-visit value. And when that happens, the words that come out of doctors' mouths are, I feel like I'm working harder and harder for less and less. So keep your finger on the pulse of that payroll ratio and this per visit value. In fact, the most important reasons for low per visit values have to do with a low production of the physicians because of one of two reasons. You are either understaffed, you don't have enough people to delegate to, or you are such high volume that it's also interfering with your productivity. You know, there's an old proverb that volume overcomes a multitude of sins. We've got to be very careful about that because at some point in time with your volume, you're going to hit that proverbial law of diminishing marginal returns. And every patient that you see is going to erode your productivity even further, and you're going to be working harder and harder for less and less. So seek out your optimum patient volume, not your maximum patient volume. Clearly there's a difference. A second reason for a low per visit value is that you have lack of integrated services. What do I mean by that? You're simply not practicing comprehensively. You're practicing like I used to be able to practice back, you know, in the early 80s. Today, we have to follow clinical protocols. We have to have integrated value-added services built into our practice, whether they be a DME program and diabetic shoes, or whether they be wound care, or whatever you pick and choose as being value-added. You simply don't want to provide services to a patient just to boost your per visit value or just to make more money. In the end, that's going to erode the entire practice based on goodwill. But pick and choose those value-added integrated services. Develop clear, concise clinical protocols, particularly if you're a group practice, that you all abide by, you all collaborate on and agree to, and then monitor them in your treatment by provider report. A third reason for a low per visit value is your fees may be completely antiquated, or your coding may be completely antiquated. So make sure you're staying on top of these things by attending seminars, coding seminars, to keep abreast of changes. And then, of course, lastly, a low per visit value. The root cause, once again, could be the fact that you're doing all this work. You have integrated services. Your fees are where they should be, but it's like trying to fill a bathtub as the water's flowing in without closing the drain. Your billing and your collection process is not up to par, and that water is just flowing right out of the drain as a result of it. So now let's talk strictly about the financials of the practice and some tips that we really need to think about within our practice that can enhance the revenue stream into your practice. And again, your AR management is the lifeblood of your practice. Why is your AR management so crucial? The fact is that the longer it takes a claim to get paid, the more likely it is that it will never get paid. That's a fact. The more likely a claim is to take to get paid, the more likely it is you're going to be writing that off. It's a game of beat the clock. So understand what it is that causes claims to get rejected. Understand what we need to do proactively to prevent claims from being denied in the first place. The number one reason for claims being denied: improper demographics. I can't tell you how many times improper demographics are collected at the front desk of our practices, and it throws the entire AR process off, it throws the entire collection process off, and it throws your entire cash flow process off. The number two reason: wrong insurance. Unfortunately, nowadays people are changing insurance like they're changing their shoes and socks. We have to make sure that our front desk is on top of asking patients when they come in, has anything changed with your insurance? Number three, I alluded to before, the number three reason for claim denials: not following correct coding initiatives, not understanding what diagnoses have to be there when you use a certain CPT code. All goes back to getting trained on seminars. We're going to be hosting a whole bunch of webinars from TRAKnet Billing Solutions. We're going to be hosting a whole bunch of webinars that everybody's invited to on things like this to increase and maximize your collections. Untimely submissions, number 4, again with number 1, 2, and 3. If things aren't corrected fast enough, you can wind up hitting timely filing deadlines. Many insurance carriers have timely filing deadlines. If you get it to them too late, you eat that claim. And number 5, the stall tactics that we talked about, which are outside of our control. I encourage everybody to do a billing audit, again, to determine how you're doing with your cash flow account receivable management. Very simple. What I encourage every administrator to do twice a year is grab 25 random charts, 25 per provider, and you're going to do this again twice a year. Make sure those charts are from patients that have been seen at least 4 months ago. The reason we say that is because you want the entire revenue cycle management to be closed on these charts. And sometimes by the time patients pay our bills, it could be 4 months, hopefully not. But choose 25 charts per provider from patients who have been seen for at least 4 months ago. And I want your administrator to compare your charge slips, your super bills, to the schedule for that day, making sure that everybody on the schedule had an encounter created in TRAKnet, and if not, explain why. I then want them to compare the charges, the charge slip of the encounter, with the chart note. Make sure that everything in the chart note is also in the charge slip, the super bill, and vice versa. Many times I'll find that the chart note clearly says x-rays were taken, but somebody forgot to click on radiographs on that super bill, and vice versa. You could have x-rays in the super bill and not documented in the chart. That's just as bad. Then compare the super bill, the charge slip, with the data entry. This applies if you're using still paper super bills, because one of the pitfalls of using paper super bills is that somebody is circling the production, somebody is circling what's done, and then handing that paper off to somebody else who then has to enter data. Therein lies a baton that needs to be passed, and that baton can sometimes be dropped. So make sure that what's on that charge slip has been accurately entered into TRAKnet. Then I'd like you to compare your EOB for the payment of these charts to your fee schedule. Now, yes, that means you need to acquire your fee schedule and make sure that you're being paid according to your contractual obligated fee schedule. I can't tell you how many times an insurance carrier will not pay you what they are supposed to pay based on your fee schedule. Now, the easy way to obtain your fee schedule is to basically call the carrier and simply ask them if you can fax to them your top 15 CPT codes. Don't try to go after every CPT code possible. They're going to shut you down. They're not going to cooperate in most instances. But simply ask them if you can fax them your top 15 CPT codes. Can they please just jot down your fees associated with those top codes? For the most part, that's going to probably occupy 80% of what you do based on the 80-20 rule. Then make sure for these 25 charts that the patient's obligations have been met. So this is the billing audit, a 5-step billing audit that's done on 25 charts twice a year for patients that have been seen greater than 4 months ago. This should be kept under the fingers of the administrator. You should also have an appeals process. And again, very simple. For the appeals process, you need the same data. You need the same tools. You need the EOBs and you need your fee schedule. Are you being paid? We're going to be soon launching in early 2015 an option known as an advanced, the name just escaped. It's a program which basically checks your fee schedule payments, making sure you have to front load and input information about your fee schedule by carrier, and then it automatically checks. It's an advanced reimbursement manager is the name of this product, an advanced reimbursement manager. It's available through our strategic partner TriZetto, going to be crucial, particularly for big groups. Okay, before I go to questions, I'm going to leave you with some tips that might not be new to everybody, but certainly some tips that can help everybody. Number one, as I talked about, develop policies and stick to them. Anybody who's on the phone with insurance carriers should take the first name and the last initial of the person they're speaking to and make notes within TRAKnet about these accounts as you're working the accounts. You should be sending out your patient invoices regularly, but by regularly, don't send them out too regularly, because don't forget, depending upon your days in receivables, you don't want to send out your patient statements, for example, every 4 weeks if it's really the 5th and 6th week that these claims are being paid, because then things get crossed in the mail. You're going to be sending out a bill to a patient on that 4th week, and on the 5th week you're going to get payment for it by the insurance carrier, and it just leads to a whole host of phone calls, unnecessary phone calls into your practice. Anybody who's at the front desk who came completely unprepared to pay, whether it be the balance or even the copay for today's visit, have available a self-addressed stamped envelope with an invoice that you immediately print off. Be proactive about this, and you will see how it really facilitates getting them to pay that, rather than just sending them on their way, telling them to pay it when they can. Be sure to ask questions to patients who owe money for big degrees of time. And that question really should be, can you tell me a reason that this claim, that this invoice is being ignored? Is there a reason that you have not paid? I think it's an important question that we sometimes ignore. I would certainly want to know that a patient is not paying this invoice and it's 4 months old or 5 months old because they had a loved one who went through an incredible tragedy which cost them hundreds of thousands of dollars. In the end, that loved one passed away. I would want to know that before I sent the patient to collections, yet we sometimes ignore asking that simple question. A rebilling fee is something that you can, by law, put into your financial agreement that you have patients sign when they enter your practice. Many doctors used to, in fact still do, charge a percentage interest rate on monies owed to them by patients that are overdue. And you can certainly do that, but if you're charging an interest rate, it's one of those things that you've got to be notifying the IRS over. Uncle Sam wants to know about it. Instead, make it simple. On the third invoice that goes to a patient, have some type of notification, a warning, if you will, that the next invoice comes associated with a $15 rebilling fee. You could do this on the second invoice. Do it to your comfort level, but make sure your patients are aware of it proactively. It should be in your financial agreements that they sign, and it should be proactively stated on an invoice before the invoice that actually triggers the rebilling fee. And you can make that rebilling fee anything you want, but keep in mind that every time you bill a patient, it costs you about $8 in human resource and in postage and materials, your time. It costs you about $8. So a rebilling fee of $15 is absolutely not unreasonable, and it's perfectly within your right to do so. Make sure that you have the availability to accept credit cards when you're on the phone with patients. You should be able to accept the payment right then and there through credit cards. You're going to be seeing news released very soon about a new integrated credit card merchant that we have as a strategic partner. So the credit card payment will automatically go right into that patient's account seamlessly. And then lastly, and very important, is the communication that takes place between your front desk person and your billing department. A patient should not come into a practice who is delinquent in an account, who now comes in today, who knows they have received 3 invoices. Your billing department knows they have received 3 invoices. Your billing department should be communicating with that front desk person to say, be sure to collect that $150 from Mrs. Jones when they come in today. Make that front-to-back communication as effective as possible. Last slide, then we'll entertain some questions, a little bit about the hosts of this webinar tonight, TRAKnet Consulting Solutions. We are a full-scope consulting service company. Again, you've heard me say on other webinars, we are striving not to just deliver an electronic health record to you, not to just deliver a certified Stage 2 EHR to you, but to have total solutions for you for all of the challenges that we face in today's environment. And Consulting Solutions is a perfect example of this. We provide meaningful use help, attestation help. We have a team of consultants who are HIPAA experts, OSHA experts, coding and compliance and billing experts, practice improvement strategies, on-site consulting, supergroup consulting, and report cards that we can produce known as virtual practice optimization report cards, where you can literally see your practice's strengths, your weaknesses, and your missed opportunities benchmarked across the TRAKnet universe. And it's, of course, all done very securely, confidentially, but you will know how you stand according to the other 2,000 TRAKnet users that we have. Here you see 2 emails. One is if you have any questions about the services. My personal email if you should have any questions about practice management or anything that we talked about tonight. So let me try to get together some questions here that are strictly related to practice management. And again, if I don't answer your question because we are running out of time, I'll be happy to entertain it by email. Is the TRAKnet billing service full service? Not only submission, but a complete claim scrubbing. Great question. Is the TRAKnet billing service, and actually last week we had a webinar sponsored by TRAKnet Billing Solutions. It is full service. It is claim scrubbing. It is claims processing. It is payment posting. It is appeals. It is patient invoicing. It is even taking the phone calls of patients when they call about their bill. We take that away from your practice, those daunting calls that you have to deal with. It includes, and the fees associated with it, of course, are based on a percentage of your collection, just like any other billing company, but our fees include the payment of your gateway charges as well as all patient invoicing. Our fees are inclusive of that. Who can we speak to make sure we have all the services we should have? Again, sales@traknetpm.com will connect you right to our sales department, who will basically educate you in terms of TRAKnet 3.0, how to download TRAKnet 3.0, begin practicing with it. Our upcoming December webinar series of training is going to be released next week. You're going to be able to enroll in live webinars multiple times a day, every day of the week throughout the month of December. You could learn all about that if you just go to TRAKnetPM.com. We currently use TRAKnet PM for EMR. We outsource our billing. Are there any services we can utilize that you offer us besides the basic EMR? Yeah, I mean, we have all of the consulting services. You're already outsourcing to somebody else your billing, but we have all of those consulting services. We have all the integrated partners that make your life easy, such as the credit card merchants, such as patient eligibility, the advanced reimbursement manager that we talked about to check your EOBs. We even have a automated marketing company called DemandForce. We talked about that on one of our previous webinars. They actually hosted a webinar. DemandForce is an automated marketing company that basically produces automated recall for you and a whole host of other magic in terms of marketing for you. All of these are part of our total solutions. Please review the payroll ratio again and how to obtain that ratio. Again, payroll ratio is your collections for the year divided by your payroll, only your staff's payroll, and the payroll taxes and your benefits that you provide them with. So if you have $1 million of collections and your payroll, as I just defined it, was $250,000, your payroll ratio is 25%, and it should be somewhere between 25 and 30%, and then you know you're hitting that mark. Who do we contact to outsource our billing to TRAKnet? sales@TRAKnetPM.com, and we'll be happy to answer questions. We'll be happy to speak to you about that. Does TRAKnet have a recommended podiatry fee schedule? No, we can't do that. If one of our attorneys from our team of experts were on the call, I would bet he would agree that if we came out with a fee schedule, that would be construed as collusion. So we really can't do that. Okay, it's 9 o'clock. Unfortunately, I'm out of time. But again, please email me personally if I did not get to your questions. Please be on the lookout for future webinars. Give us recommendations for future webinars. We're happy to, just like we're happy to build and shape TRAKnet 3.0 throughout the year of 2015 as our users want it to be, we're happy to also provide the educational content to what you see as important. I want to thank everybody here for joining tonight, and we look forward to seeing you on future webinars. Good night, everyone.